Everyone knows Raffles Medical, and most investors have heard of Q&M Dental. But what if I told you there's another hidden healthcare stock in Singapore, one that quietly makes 40% profit margins, pays consistent dividends, and trades at only 6 times earnings? Meet HC Surgical Specialists, SGX, 1B1, the small-cap medical stock that could be Singapore's next healthcare gem. In today's video, we'll uncover why this overlooked endoscopy specialist might actually be more profitable than Q&M, and even run leaner than Raffles Medical, yet trades at a huge discount. HC Surgical Specialist started back in 2015, founded by Dr. Hyesu Min, a colorectal surgeon who believed quality healthcare shouldn't just be for the elite in private hospitals. He wanted to bring specialist-level surgery, like colonoscopies and endoscopic procedures, right into the heartlands. Fast forward to today, that vision has become a network of 11 endoscopy centers and clinics across Singapore, serving patients from Bukit Batok to Siglap. Over the years, the group expanded beyond just colorectal care, now offering orthopaedical surgeries, home medical services, and GP care. It's a business built on recurring demand, AIA insurance partnerships, and a rapidly aging population, a combination that keeps patient flow steady all year round. And here's the kicker. Despite its small market cap of just 56 million Singapore dollars, HC Surgical generated 19 million Singapore dollars in revenue and 8 million Singapore dollars in net profit last year. That's a 43% profit margin, higher than Q&M Dental's 12% and miles above Raffles Medical's 8%. In other words, this small-cap clinic is quietly running circles around some of Singapore's biggest healthcare names. Now, let's take a look at how HC Surgical Specialists made its money in 2024. The group generated about 18.8 million Singapore dollars in total revenue, and as you can see from the chart, a massive 70% came from its core, endoscopy and surgical procedures. That's the bread and butter of the business, driving the bulk of profits and patient flow across its 11 clinics island-wide. The next 10% comes from a new orthopaedics division, which was added recently and is starting to grow as more surgeons join the team. Another 10% comes from home care and general practice services, a steady, recurring stream that keeps clinics busy even outside of surgery hours. And finally, about 10% comes from equity income and medical investments, partnerships with firms like Medisave and Total Orthopaedics that add an extra layer of profitability. Together, this gives HC Surgical a strong, diversified income base, and despite its small size, the company continues to punch far above its weight in Singapore's healthcare sector. Let's take a look at HC Surgical Specialist financial performance over the past 7 years, from 2019 all the way to 2025. What stands out immediately is stability. Revenue has consistently hovered around the $18 to $19 million range, showing a resilient business model even through COVID and the post-pandemic years. In 2025, revenue came in at $18.5 million, just slightly below last year's $18.8 million. Net profit after tax remained healthy at $3.3 million, maintaining a 17.9% profit margin. That's still higher than many larger healthcare peers, showing strong cost control and solid clinic utilization. Cash flow continues to be a major strength. The company generated nearly $6 million in operating cash flow in 2025, ending the year with a solid $8 million in cash reserves and minimal debt, just 11.9% gearing. This gives HC Surgical a strong foundation for growth or acquisitions if opportunities arise. Earnings per share dipped slightly to 2.17 cents, but the group still rewarded shareholders with a 1.6-cent dividend, reflecting its continued commitment to payout consistency. Meanwhile, return on equity stayed stable at around 10%, showing that management continues to extract good value from its capital base. Overall, the numbers paint a picture of a small but steady healthcare group, disciplined, cash-rich, and profitable, navigating Singapore's competitive medical landscape with quiet efficiency. Now, let's take a closer look at HC Surgical Specialist valuation and performance metrics from 2019 all the way to 2025. First, the overall trend. The company has been remarkably steady. Market capitalization grew from around 50 million Singapore dollars in 2019 to roughly 62 million in 2025, showing investor confidence despite short-term profit fluctuations. Enterprise value stayed closely aligned, sitting near $58 million in the latest financial year, supported by healthy cash reserves and low debt levels. Valuation ratios remain extremely attractive. The price-to-book multiple is just under 3 times, and the trailing P/E ratio has compressed from about 18 times in 2019 to only 7 times today, signaling deep value relative to peers like Q&M Dental or Raffles Medical. Operationally, HC Surgical continues to deliver efficiency. Return on invested capital sits around 11%, while EV/EBITDA has improved to roughly 4.5 times, reflecting stronger cash conversion and lean cost management. The EV/sales ratio has gradually fallen to 1.7 times, another indicator that the market is undervaluing its steady revenue base about $18 to $19 million per year. And despite these modest valuations, the group remains shareholder-friendly, maintaining a 2-cent dividend per share, translating to a yield of roughly 4%. In short, HC Surgical Specialists is small, disciplined, and consistently profitable, a classic microcap healthcare stock trading at value-level multiples, yet backed by robust cash flow and consistent dividends. Here's a quick look at the key opportunities and risks for HC Surgical Specialists. On the opportunity side, the group's biggest growth driver is the orthopaedics expansion, which is already performing strongly. Its long-term partnership with insurers like AIA and a solid Heartland Clinic network give it recurring patient flow and strong brand trust. Financially, the company is debt-free with $8 million in cash and continues to consolidate its medical portfolio, building a steady platform for future growth. But there are also risks. Profit can fluctuate due to fair value swings in its investment holdings, and rising locum and staff costs could pressure margins. Lease commitments and its full reliance on Singapore's domestic market also limit flexibility. Overall, HC Surgical remains a cash-rich, well-managed healthcare group, balancing stable recurring demand with measured expansion into new specialties. So here's the final verdict. HC Surgical Specialists may not be a big-name healthcare stock like Raffles Medical or Q&M Dental, but it's quietly delivering where it matters most. Consistent revenue, solid profit margins, and one of the strongest balance sheets among Singapore's small-cap medical players. With a 6.7% dividend yield and new growth coming from orthopaedics, this is a classic steady compounder, small, disciplined, and cash-rich. Of course, investors should still watch for staff cost pressures and investment fair value swings, but overall, HC Surgical looks like a low-risk, slow and steady winner in the healthcare space. If you found this breakdown useful, hit that like button. It really helps the channel reach more investors. Don't forget to subscribe to Durian Finance for more deep dives into Singapore stocks. And drop a comment below. Would you invest in HC Surgical, or do you prefer the bigger healthcare names? I'd love to hear your thoughts.